Welcome everyone to Vested Interest. This is Shane back for a Stock Pick of the Day video. Today we are going to take a look at one out of the information technology sector, Apple, and you are probably well aware of it. You may be watching this video on an Apple product if it's not a tablet or a phone, possibly even Apple TV. Before we get too far in the video, if you could do me a big favor, it doesn't cost you a thing but a couple of seconds of your time. If you could hit that thumbs up button down below if you find any value in the content. Make sure you're subscribed to the channel. Click that subscribe button. Join us on this journey to financial freedom. Join the Vested Interest community. Hit the notification bell so you're notified whenever I put out any new content. There is the thanks button down below if anyone would like to help out the channel financially. That way, you can buy me a cup of tea. And a special thank you to the viewers and subscribers of the channel. The channel continues to grow because of guys and gals like you. A couple other things to look at. Watch time, if you could watch the videos to the end or as much of the video as you can. Watch time is one of the metrics that the YouTube algorithm looks at. Drop a comment down below, let me know what you think, and share with anyone you think that might find value in the content as well. Doing all that, again, really does help out a small YouTube channel like mine and push the videos out to some more people out there in the YouTube world. Now, this is the Vested Interest Stock Screener. This is the criteria we will be looking at in the video. We will not be looking at this down at the bottom, price to book we add in for companies out of the financial sector, primarily for banks, but anything in the financial sector, we add that in. So it must meet 5 of 8 to make it onto my watch list. And just because it does, or if it does not necessarily mean I am investing in the company. It just means I am interested in doing more of a deep dive into the financials, looking at their balance sheet, their income statements, and some other metrics, doing a discounted cash flow analysis on the company, and then maybe potentially adding it in the future. Or if it's a company in my portfolio, it is a way I back check to see if it's still meeting some initial screener criteria that I have set up. And if it doesn't, then maybe I need to go back in and look at the financials and see what's going on with the business. All right, back to Apple. Check them out at www.apple.com. And again, unless you've lived out underneath a rock somewhere, you are probably well aware of this company and probably have some of their products that you use. You know, you've got MacBooks, the iPhone, the iPad, the Apple Watch, Apple Pro Vision, that's a relatively new one, AirPods, AirTags, Apple TV now, other products out there. They're cell phone providers and service providers. They have the, what is it called, the Apple Tech there if you want to go to one of their stores and get some technology help there. With their products or just in general, they offer that as well. So they offer a lot of different products in the technology space and cell phone space, keeping you connected, as well as, like I said, the Apple TV, that's a relatively new one, and the Apple Vision Pro, their 3D headset that they have now as well. And again, www.apple.com, www.apple.com. That is their homepage there. Now, the reason we are taking a look at Apple today, Apple Inc., ticker AAPL, down 0.6% on the day. Not a big drop, but a drop nonetheless. And there was not a lot of red in the market overall today, so this was one of the few that was down. And that's why we're taking a look at them. 52-week range as low as $169.21, as high as $260.10. Not quite within 15% of a 52-week low right now. Let me just check that. Is that correct? It looks like they might be pretty close. Did I do my math wrong? 169.21 times 1.15. Yep, nope, they've got to drop to $194.59 or less to be within 15% of a 52-week low. So not quite there at $200.30. Market cap of 2.992 trillion. So this is a mega cap company here. Beta of 1.21. They are slightly more volatile than the overall market. The market being 1. Price to earnings ratio, PE ratio, seems elevated to me, $31.15. Anything over, really over a 15 PE is supposed to be overvalued, but we have a very elevated market. I would not be looking at a whole lot over 20%. Unless it's a very fast-growing company. And I don't believe Apple is really growing fast enough to justify such a high price earnings ratio. But I could be wrong. EPS, earnings per share, $6.43 per share. Earnings date coming up sometime between July 30th and August 4th in that window there. Forward dividend, $1.04. They are quarterly payers, so divide by 4 or wait till the end of the video here. We'll touch on their dividend history. Forward yield is 0.52%, so very low starting dividend yield on this one, ex-dividend date. was May 12th. Looks like they paid out on the 15th. So they've already paid out. You would be in line for the next dividend, but you're going to have to wait a couple months longer to get it. 1-year target estimate, $228.85. So they see some upside, at least from Yahoo Finance, where I pulled this information from where it currently sits at the $200 level up to $228, but not back to its 52-week high at $260 and some change. So something to note there. Upside potentially, but not back to its 52-week high. Jumping over to the right, I like to look at dividend yield theory to see if the company is potentially undervalued. To do that, we look at their 5-year dividend yield average of 0.56%. We compare it to their current 0.52%, or over here forward 0.52, same number. Since it is lower than their 5-year average, that speaks to overvaluation, slight overvaluation, almost right at fair value, but just slightly a tick overvalued according to dividend yield theory. Payout ratio very low at 15%, 15.58 to be more specific. Dropping down, looking at free cash flow. I want growing free cash flow over time, because typically if a company has free cash flow that is growing, they can do some things with it. They can make acquisitions, reinvest back into the company, pay down some debt, buy back shares, pay a dividend, which this company does, and raise that dividend over time, as well as keep some of that free cash flow on the balance sheet as cash or reinvested if they so choose. Now, going back here to December 2022, you can see $111 billion in free cash flow. 2023 slightly down to $99 billion. 2024 back up to $108 billion. Trailing 12 months, which again, keep in mind this does include some of 2024 numbers since we're only in late June of 2025. $98.486 billion there. Does look like they're repurchasing shares as well. $89 billion pulled out in 2022. 2023, $77.5 billion. 2024, $94 billion. Trailing 12 months, $101. But again, keep in mind that the 2025 numbers, which is where the trailing 12 months is, we are in 2025, but that does include some of 2024 since we're only halfway through the year. All right, jumping over to stockanalysis.com, another source I go to for information, and I do recommend more than one source for information so you can back check the information you're looking at is accurate and up to date. Now, they have 35 analysts that have taken a look at this. They call it a consensus buy here. Low estimate of $160. That would represent a 20.18% decrease from where it currently sits. Average estimate of $237.36. Pretty close to what we saw with Yahoo Finance on the previous page. That would represent a 18.41% increase from where they currently sit. And if it happened to hit their high of $300, that would be a 49.66% increase. That would also be a new 52-week high. Jumping into some of the statistics, I like to look at return on capital employed, and I like 10% or better here. They're at 68.23%, smoking high. That is a very good return on capital employed. They're very efficient and effective at deploying their cash and capital back into the business. Earnings per share growth, I like 5% or better forecasted over the next 5 years. They're looking at 14.87% forecast, which is almost 3 times what I like at 5%, and revenue growth is forecasted at 6.62%. This is not part of my initial screener, but I like to look at it anyway. It's right there, so it doesn't take me any more time to snip it, and I like to look at it. Revenue is part of more of a deep dive whenever I look at the financials. Now, quarterly payer, as we mentioned, payout ratio 15.78, very low. I like under 75%, so this is extremely low payout ratio in my opinion. Dividend growth of 4.12%. I would like to see more growth. With such a low payout ratio and such a low starting dividend yield, I would like more growth for a company like this. Growth of 13 years, buyback yield is positive at 2.71%. That means when they are buying back shares, they are doing it effectively, buying more shares than they are issuing into the market. So you want to see that positive. If you see a negative, that means they are issuing more shares than they are buying back. Shareholder yield is positive as well at 3.22%. Want to see that positive as well. They do pay out off schedule February, May, August, November from most companies. Most companies start out their payments in March. So like to see an off schedule payment. Helps balance out your income if you are investing for income. I like to try to get companies that pay out every month throughout the year, not necessarily a company that pays out every month, just a mix of different companies that pay out different schedules so that I have a company paying out each month. I have had monthly payers. Realty Income was one in my portfolio. I don't currently have any right now, but I have had monthly payers before, Realty Income being one. Now, going back here in time, looking at dividend history, November 2022, 23 cents, raised that up May of 2023 up to 24 cents, raised that up again May 2024, or yeah, 2024 up to 25 cents. Most recent raise was May of 2025 here at 26 cents. So see that, just 1 penny. I mean, that's just, I mean, do you even really consider that? You know, I know they're technically a dividend payer and they are raising their dividend, but a penny raise for such a large cap company, mega cap company, and such large free cash flow and such a low payout ratio, I would just like to see that even at 8%. Even if you made it 2 pennies, 3 pennies, you know, not a huge raise, but would still be a little better than this 4.12%. But it is what it is. All right, let's wrap this one up and run it through the screener. Understand the business. I mean, again, unless you've lived under a rock, you should understand Apple's business, right? Steve Jobs made them a household name with the iPhone, and then they branched off into other electronics, communications, and technology that they're providing for you. So that's what they do. Again, you may have an Apple phone or an iPad or the watch. I think my daughters have the watch, and I think they all run the iPhone. I have a what do you call it? Android, I guess. But they like the Apple stuff. Growing free cash. I think we have the what are they, little iPods or whatever that you can track your, we use them whenever we go on vacations. You can track your bags or whatever. They've got that too. Growing free cash flow. No, you had a little bit of up and down in the free cash flow. Growing dividend, yes, a little over 4%. I'd like to see that, 8% or better, but it is what it is. Love to see double digits if it was one I owned, but such a low payout ratio with such high free cash flow, it seems like they could do better than a 4% growth. Dividend payout ratio of 75% or less. Yes, they are well under 75% at only around 15%. Dividend yield theory says they're potentially slightly overvalued. I mean, just barely. Really, you could call them fair valued, but technically slightly overvalued according to dividend yield theory. Buy below current cost basis. They are not quite within 15% of a 52-week low, so no check there. Return on capital employed smoking high, right? So check there. Earnings per share growth was a little over 14%, so well over the 5% I'm looking for. 1, 2, 3, 4, 5. This one does make it onto my watch list. I believe that their growth is slowing, so definitely look at the financials of the company. I think there are better opportunities personally, in my opinion. Google is one I have been buying out of the Magnificent Seven with its recent pullbacks, and even though they tried to bounce back here recently, I feel like they're back in the mid 160s and wouldn't be a bad buy here. I'd like to see more of a pullback on this one personally, but it does make it onto my watch list. Let me know what you think of Apple in the comment section down below. All right, that is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the best interest community. Drop a comment down below. Let me know what you think of the video. Let me know what you think of Apple. Is it one you're buying? Is it one you're watching? Maybe it's one you were selling and you're part of the reason for the downturn today. And if you are selling or buying or waiting on a better price, let me know what you're waiting on down in the comments section down below. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those that take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great week, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing in educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor. And for those of you who have made it to the end of the video, thanks for watching to the end. Again, watch time is one of the YouTube metrics that the algorithm looks at, so I really appreciate it. Don't forget to hit the subscribe button, like the video, share with anyone you think that might find value in the content, drop a comment, and hit the notification bell on your way out. We'll see you next one.